Imagine this. You've just started investing. You've opened a brokerage account, transferred your first money, bought some stocks or ETFs, and suddenly the news hits. The market drops 15%. Your portfolio turns red right before your eyes. Your heart races, one thought pounding in your head, I'm going to lose everything. Your hands reach to sell just to save something. Sound familiar? That's the dark side of risk. Volatility, sharp drawdowns, the terror of losing everything you worked so hard to save. For most beginners, risk looks exactly like that, a huge monster lying in wait to devour your savings. And many quit right here. They close the account, go back to a savings deposit, and tell themselves, investing just isn't for me. But risk has a second face, the bright side, the one only those who didn't run away at the first storm ever get to see. Without risk, there is no return above inflation. That's an iron rule of the market. Look at the numbers. A bank deposit today gives you 4 to 6% per year at best, barely covering inflation, sometimes even losing to it. Reliable corporate or government bonds, 5 to 7%, but stocks, especially the broad market through indexes, deliver 7 to 10% per year on average in the long run, sometimes more. Why? Because investors demand compensation for enduring uncertainty. The higher the risk, the higher the potential reward. Risk is the price you pay for the chance to outpace inflation and truly grow your capital. Let's compare it to riding a bicycle. The first time you get on, it's terrifying. You're sure you'll fall, crash, get hurt. But if you don't try, you'll never ride. Once you learn to balance, speed, freedom, wind in your face. Falls still happen, but they no longer stop you. They teach you. It's exactly the same with investing. The first drawdowns scare you to the core, but it's through them that you realize the market always comes back. And those who stay in the game get the speed a deposit can never provide. Ignoring risk means staying trapped in low returns forever. It's like riding a kick scooter on a bike path while others race down the highway on road bikes. Yes, safer, but so much slower. The right approach to risk turns it from an enemy into an ally. Not avoiding risk completely, but learning to manage it. Diversify. Keep a 10+ year horizon. Don't panic during drops. Keep contributing regularly. Once you master this, fear fades and calm confidence takes its place. This very transition from terror of risk to the ability to work with it is what lays the foundation for the biggest turning point in your investing life. Without it, that turning point simply won't arrive. The turning point. Now let's talk about the most important thing, the turning point in investing. This isn't just when things feel calmer inside. This is the moment when your money takes over the steering wheel, when your portfolio starts growing on its own, stronger and faster than you can possibly add from your paycheck. The turning point is when the annual growth from the market, dividends plus capital appreciation, exceeds the amount you contribute each year. Let's break it down with simple numbers. Suppose you contribute $15,000 a year. That's a pretty typical amount for someone who takes investing seriously. At a $200,000 portfolio and an average return of 7 to 8% per year, the market gives you $14,000 to $16,000. Almost parity. Your contributions and market growth are roughly equal. At $300,000 to $350,000, the market delivers $21,000 to $28,000 a year. Your $15,000 is no longer the main driver. The market is now outpacing you. At $400,000 plus, you're getting $28,000 to $32,000 plus from the market every year. Contributions become a nice bonus, not a necessity. And right here, the real magic happens. You catch yourself thinking, if I stopped adding money right now, my portfolio would still keep growing toward my goal. In 10 to 15 to 20 years, it would get there on its own, to $1 million, $2 million, whatever I'm aiming for. This is exactly the moment when contributions become optional. It's like you've coasted to shore on the right amount. The idea many people call coast fire. You've built enough base that time, and compounding will carry you the rest of the way to full financial freedom without any extra effort. Work, contributions, stress, all of it becomes something you choose, not something you're forced to do. Of course, risks don't disappear. The market will always swing, but now they're under control. You're no longer a victim of the fluctuations. You're the one harnessing their power to your advantage. It's an incredibly liberating feeling. How long does it take? Don't think the turning point will arrive out of nowhere. It's a gradual process that stretches over years, but it feels very clear at different stages of life. Here's how the journey typically looks for most people who start investing in their 20s or 30s and stick with it consistently. Part 1. Building the base. The first 3 to 6 years of the journey, you contribute money regularly and the portfolio grows to the first meaningful amounts. Here, compounding is still weak. Most of the growth comes from your contributions, but this is when you learn the most important lessons. Don't panic during drops. Buy on dips. keep fees low with ETFs. The feeling is, I'm just putting money in and waiting. Many people quit at this stage. Progress feels way too slow. But if you stay the course, you're building momentum for everything that comes next. Part 2, when the market starts helping. Roughly 6 to 12 years in, the portfolio has grown noticeably and market growth becomes comparable to your annual contributions. In crises, the portfolio falls much less than the overall market and recovery happens faster. You start noticing, my portfolio is already working for me, not just me working for it. This is when many people first think, what if I cut back contributions for a year or two? Would it really change the big picture? This phase is when fear fades and confidence begins to grow. Part 3, confidence and freedom of choice. 12 to 20 years in and beyond. The market now brings in more than you contribute. Contributions turn into a nice bonus rather than a necessity. You watch recession headlines calmly and think, we'll get through it, like always. Many people reach this stage earlier. If they started young, increased their income and contributions, or the market was favorable. The feeling is, I could work less, live more calmly, or keep saving to retire even earlier. This is the zone where real freedom appears. Key insight: the timeline depends not on luck but on 3 things: starting early, staying consistent, and keeping fees minimal through index funds. Those who begin at 22 to 25 and never skip years often reach the optional contribution stage by 35 to 40. Those who wait for the perfect moment stretch it out over decades. Patience here isn't just a virtue, it's the most powerful accelerator. Those who stick with it look at the numbers after 10 to 15 years and realize this really works, and faster than I ever expected. How to accelerate the path and build a risk-neutral portfolio. The speed at which you reach the turning point depends not on luck, but on your decisions. Here are the key factors that bring it closer. First, asset selection. Low-cost index funds and ETFs that cover thousands of companies worldwide deliver the fastest and most stable growth. Risks are spread broadly. A drop in one company is barely noticeable, and recovery comes quicker. If your portfolio is concentrated in a narrow group of assets, volatility increases, drawdowns become deeper, and the path to the point where market growth exceeds your contributions stretches out by years. Second, regular rebalancing. Once a year, or when allocations deviate significantly, you reset to your target proportions. Sell what has grown a lot, buy what has fallen. This disciplined approach locks in gains and buys low, adding 0.5 to 1% to annual returns without extra risk. Third, tax advantages. Accounts with tax deferral or exemption let your money grow faster. Every dollar saved on taxes continues compounding instead of being taken away. When these elements come together, your portfolio becomes risk neutral. Risks don't disappear, but they stop controlling your emotions. You can go with the flow without panic. Even in a severe recession, drawdowns remain moderate, and recovery happens automatically thanks to diversification and rebalancing. Imagine, you've built a base of $250,000 to $400,000 with the right balance. From this point, you can significantly reduce or even freeze contributions. The market and time will carry you to your goal. A 35-year-old investor with that amount, at an average 7% return, can reach $1 million plus by age 60. Even if they stop actively adding money. Risks no longer dictate your life. You set the rules for them. This is true freedom. The portfolio self-regulates and you simply watch it grow. It's not a lottery. It's a system built on calculation and discipline. The turning point in investing isn't some mythical point on a chart. It's a quiet but powerful shift. When you stop fearing the market and start harnessing its strength. When risks no longer control you, you control them. When your portfolio grows faster than you can possibly add money. When you first realize I can slow down, reduce contributions, or even stop them entirely, and I'll still reach my goal. This isn't about get-rich-quick schemes or genius hacks. It's about discipline, patience, and smart choices. Low fees, diversification, rebalancing, tax advantages, and time working in your favor. Start today, even with a small amount. Every month you contribute and stay the course, you move closer to that freedom. In 5, 10, 15 years, you'll open the app and see. The market has done more than you ever could on your own. And in that moment, everything changes. Fear disappears, confidence arrives. Life becomes simpler and calmer. If this video helped you see your investing journey more clearly, hit like, subscribe, and turn on notifications so you don't miss the next breakdowns. And now the most important part, this video is not financial advice or an investment recommendation. Everything we've discussed is general ideas and historical patterns. Investing always involves risks, including the potential loss of capital. Markets can fall, returns are not guaranteed, and past performance does not predict future results. Before taking any action, be sure to consult a licensed financial advisor, assess your own situation, risks, and tax implications. You make decisions entirely at your own risk and responsibility.